Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve has held its policy rate steady at a range of 3.50 to 3.75% for four consecutive meetings now in 2026, according to Argent Financial's July market update. But here's the dislocation that's driving institutional flow. While the Fed pauses on the front end, the 10-year Treasury yield has surged to a range between 4.44 and 4.48% as of early July. Reuters reported a 10-year yield closing at approximately 4.48% on June 17, 2026. That's a critical inflection point for bond equity rotation, and we're seeing massive capital reallocation as a result. Let's break down the yield curve dynamics first because this is where the trade thesis originates. The two-year Treasury is trading around 4.12 to 4.14%, while the 10-year sits near 4.48%. That's a modestly upward sloping curve, signaling that despite the pause in short-term rate hikes, long-term borrowing costs are rising. This curve structure is unusual given the Fed's hold, and it reflects persistent inflation expectations and macro uncertainty tied to geopolitical developments, particularly in the Middle East. According to Reuters coverage on war-driven inflation fears, Treasury yields have held near the high end of their recent range, even as market participants remain cautious about inflationary pressures from ongoing conflicts. The 10-year yield pushing above 4.5% is a psychological and technical threshold. When yields rise, bond prices fall due to their inverse relationship. That dynamic makes existing fixed income holdings less attractive, especially when you compare the modest returns in bonds to what equities have been delivering. Here's the performance differential that's accelerating the rotation. The Bloomberg U.S. Aggregate Bond Index returned approximately 0.67% for the second quarter of 2026, according to Argent Financial. High-yield bonds did better, gaining around 2.5%, but those returns pale in comparison to equities. The S&P 500 registered a record close at 7,420 on June 17, 2026, and posted a 15.2% gain for the second quarter alone. Year-to-date equity gains are well into double digits, driven by a combination of defensive sector strength, energy rebounds, and financials outperformance. The institutional rotation is clear. When 10-year treasuries are yielding 4.48%, but bond total returns are barely positive due to duration risk and price depreciation, capital flows toward equities that offer both income and capital appreciation potential. This is particularly true for dividend-paying stocks, which are functioning as quasi-fixed income alternatives with better growth prospects. Let's talk sector rotation because this isn't just a broad market move. It's highly concentrated in specific pockets of the equity market. Energy stocks have been one of the standout winners. One detailed market update reported energy sector gains upward of 38% recently, driven by geopolitical volatility and oil price dynamics. Energy names benefit from inflation, pass-through, and supply constraints, making them attractive in a higher-for-longer rate environment where input costs are elevated but margins remain protected. Financials are another key beneficiary. With short-term rates anchored near 3.75% and the yield curve steepening, banks and financial institutions see improved net interest margins. They borrow short and lend long, so a steeper curve directly boosts profitability. Financials have outperformed as institutional investors recognize this dynamic and allocate capital accordingly. Defensive dividend payers are also seeing strong inflows. According to Southern Securities' analysis of the stock market rotation in July, investors are shifting toward dividend aristocrats and stable yield names as bond alternatives. These stocks offer income comparable to or exceeding investment-grade bonds, but with the added potential for capital gains and dividend growth over time. This is a direct substitution trade, swapping fixed income exposure for equity income with better risk-adjusted return profiles. The equal-weighted S&P 500 has begun outperforming the capitalization-weighted benchmark, signaling that the rotation is broadening beyond mega-cap tech. This is a critical technical development. When equal weight outperforms, it means capital is flowing into a wider array of sectors and names, not just the largest tech stocks. That's a sign of a maturing rally and a rebalancing of institutional portfolios away from concentrated tech exposure and toward a more diversified mix of cyclicals, defensives, and value names. Loomis Sayles' July 2026 investment outlook highlighted that this rotation isn't simply about picking winners between asset classes, it's a rebalancing play. Institutional investors are weighing equity exposure alongside diversified approaches that include selective credit, real assets, and alternatives. But the core thesis remains, with fixed income delivering muted returns in the face of rising yields. Equities offer superior risk-adjusted returns in the current macro environment. Let's address the macro backdrop driving this higher-for-longer scenario. Core inflation remains persistently above the Fed's 2% target. The central bank's pause signals confidence that rates are restrictive enough to slow demand, but the surge in long-term yields suggests markets are pricing in either sticky inflation, higher term premiums, or both. Geopolitical tensions, particularly energy supply concerns tied to Middle Eastern conflict, are adding upward pressure on commodity prices and inflation expectations. American Century's 2026 Global Fixed Income Outlook for Q3 noted key trends including rising term premiums and investor demand for yield. When real yields on 10-year treasuries approach or exceed 1.5 to 2% after adjusting for inflation, that's historically attractive for bonds. But in the current environment, equity risk premiums are compressing, making stocks relatively more attractive even as yields rise. The trading setup here is straightforward. If you're long-duration fixed income, you're facing negative total returns as yields climb. If you're rotating into equities, you're targeting sectors with pricing power, income generation, or direct benefits from the current yield environment. Energy, financials, and dividend aristocrats fit that profile. The second quarter S&P 500 gain of 15.2%, it is evidence that this rotation is already well underway and gaining momentum. There's also a psychological component. The S&P 500 closing at a record 7,420 in mid-June creates a wealth effect and positive momentum feedback loop. Institutional allocators who were underweight equities are now playing catch-up, further accelerating inflows. The combination of strong equity performance, muted bond returns, and a Fed on hold creates a technical and fundamental backdrop that favors continued rotation. U.S. Bank's analysis on how changing interest rates impact the bond market and stock market reinforces this dynamic. Rising long-term rates typically hurt bond prices, but can support equities if the moves reflect growth optimism rather than inflation panic. Currently, the market is interpreting the yield surge as a normalization of term premiums rather than a crisis signal, which keeps equity risk appetite elevated. Bank Rate's breakdown of 6 key ways the Federal Reserve impacts your money underscores how the Fed's pause at 3.50 to 3.75% affects borrowing costs, savings rates, and investment returns. For traders, the takeaway is that with policy rates stable but long-term yields rising, the opportunity cost of holding cash or short-duration bonds increases, pushing capital toward risk assets. Looking at crypto and alternatives, the rotation story is less pronounced but still relevant. Bitcoin and Ethereum have shown mixed performance in this environment. Higher real yields typically pressure non-yielding assets like crypto, but institutional adoption and diversification demand are providing some support. The fixed income to equity rotation is the dominant narrative, but alternative assets remain on the radar for traders seeking diversification beyond traditional stocks and bonds. The forward-looking question is whether this rotation continues or reverses. If the 10-year yield breaks above 4.6%, that could start to weigh on equity valuations, particularly for growth stocks with long-duration cash flows. But as long as yields remain in the 4.4 to 4.5% range and corporate earnings hold up, the path of least resistance for capital is into equities, especially sectors with defensive characteristics or inflation hedges. Watch the Fed's next meeting for any signals on future rate cuts. If the central bank signals a pivot toward easing, that could steepen the curve further and accelerate the rotation. Conversely, if inflation data surprises to the upside and the Fed hints at resuming hikes, bond yields could spike, potentially stalling the equity rally. For now, the market is pricing in a higher-for-longer scenario with a gradual normalization, which supports continued equity inflows. Key levels to monitor. 10-year yield at 4.5% is resistance. A break above could trigger profit-taking in equities. S&P 500 support around 7,300. A hold above that level keeps the uptrend intact. Energy sector performance relative to the broader market is a tell for inflation expectations. Financials outperformance signals confidence in net interest margin expansion. The institutional rotation from fixed income into equities is one of the defining trades of mid-2026. With the Fed on hold, yields elevated, and equity sectors showing strong performance, the risk-reward continues to favor stocks over bonds for active allocators. This isn't a short-term tactical move. It's a structural reallocation driven by yield dynamics, inflation persistence, and sector-specific fundamentals. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.